Now, it's a well-documented fact that there have been a ton of new entrants to the equity markets. Demat accounts are being created by the 1,000 every day. And what that means is that quite a few individuals like yourself are perhaps cutting your teeth on the equity markets, buying shares. There is a process involved in the selection of shares, and you should, in fact, be familiar with at least the basics of it. So I thought today, let me introduce Vivek Bajaj. Let me speak to Vivek Bajaj from StockEdge. He's the co-founder of StockEdge and Elearnmarkets about some aspects of this. Thanks so much, Vivek, for joining in. Always a pleasure speaking with you. A lot of people are entering the stock market, like I said, but I've heard the term short-term investment. So people perhaps not really sure about whether they are long-term investors or traders. What approach should people have ideally when they're approaching the stock market for the first time?
So short-term investment is actually means that you are investing for a short term, which is right in the middle between trading and investing. Now, when we talk about short-term investing, when we talk about playing the momentum in the market. So you see in this kind of a market, which is extreme bull run right now, you'll see a lot of stocks which are gaining momentum. And you would like to participate in that momentum rally. So you buy those stocks where momentum is high, and then you sell once you see that the momentum is dying down. So short-term investment is actually a kind of a trading, but then because you use cash market to trade, it tend amount to investing.
Yeah, and I think your definition is much clearer than what those individuals themselves think that they are doing, which is why I was asking you that. In an ideal situation though, Vivek, for someone who's just cutting their teeth, someone who's just entering the market, how long do you think that people should hold their investments once they do select those stocks? And we'll get into the how to select stocks in just a bit, but what is the duration they should be willing to give?
Actually, it depends upon the objective of the person. I always tell this to people that you should have a good mix in your portfolio. So there should be stocks which are driven by value and growth. There should be stocks which are driven by momentum. So certain percentage should be there in the category of value and growth. Certain percentage should be there in momentum. And because we are in a cyclical bull run, so there is a business cycle revival which we are seeing. So all the cyclical sectors, for example, commodities or any sector which is interest rates driven is also performing. Real estate, it is performing. So a bit of portfolio allocation in cyclical stocks is also recommended. So there are three categories largely: growth, value, momentum, and cyclical. So in bull run, the allocation becomes very different. And when the market goes down, the allocation changes. You move more towards growth and value and move out of momentum. But in bull run, obviously, your allocation towards momentum will be higher than in the value stocks.
I understand what you're saying, and you're talking about a diversified strategy even within this basket of equities that you're holding, and it depends, of course, what your objective is. But let's talk about some of the factors that could determine the selection of the stocks that you are in. Let's talk about valuations. What, according to you, are the key metrics? And of course, we could talk at length about the various schools of valuation and how you yourself would look at it. But from the perspective of the individual investor, maybe someone who is not as adept, maybe who doesn't have as much time as the professional, what are the key metrics to look at?
Okay, when we talk about valuing any stock price, we should always understand there are two components in any stock price. One is the intrinsic value of that stock, and other is the speculative value of the stock. And typically, we all see that when there is bull run, the speculative value of the stock becomes far, far higher than the intrinsic value. And in the bear market, when the market falls, obviously you would like to invest in stocks which are nearest to their intrinsic value. Now, both these valuation methodology, both these components have their own ways of measurement. For example, PE multiples, which is price earning ratio. Now, in a very standard manner, PE ratio is something which measures whether the stock has become overvalued or undervalued. And it is largely said that if a stock is near its average PE over historical PE, then that means the stock is fairly valued. And if the stock goes way above the average PE, that means the stock is overvalued. So PE becomes the most rudimentary way of evaluating the valuation. But one has to remember that in a bull run, PE expansion also happens. Let's take an example that if a company is earning, say, 10 rupees per share, and the PE of the company, the historical PE of the company is, say, 20. So the market price will be 10 into 20, which is 200, right? But when the bull run comes and everything looks very rosy, people are very optimistic about life, then this PE of 20, it actually gets re-rated and 20 becomes 30. So automatically the current market price at the same earning of 10 becomes from 200 to 300. So in a bull run, both happens. The revenue expansion happens, the earning expansion happens, which is the earning 10 rupees will become, say, 20 rupees. And PE expansion also happens. That means the PE of 20 will become 30. So the stock price, which was around 200 at that time, actually goes up phenomenally high because of the high hope and expectation from the market. So PE is the most standard way of evaluating whether a stock is overvalued or undervalued. And there are other ways and means as well. For example, relative valuation, for example, discounted cash flow method, which is essentially the discounting of the future earning, etc., etc. But I don't want to get into that because those are more technical answers. For a normal layman, I think PE is the most easily understandable and comprehensible concept.
Just to follow up to that question on P and that answer rather on PE, which is to say that if you understand the company, if you understand the business that it does, then you can have your own estimate as to how much you expect the revenues and the profitability to grow. Therefore, you can have your own estimates as to how much the earnings per share is going to grow, and you can map out your own PE as well, right? Because you're essentially thinking, okay, I buy it now for the prospect of future growth. So is there some way in which an average investor can also understand this and make their own projections?
Well, if I have to, classify PE further, so there are two kind of PE. One is a historical PE, which is basically essentially the trailing PE. So right now, what the company is making and how much value the market is giving to that company, that defines the current trailing PE. And forward PE, which is the future estimated earning of the company. And if the current price is X, then what is the current forward PE? Now, for a normal layman to project future is always difficult. It's not easy. And that's why market is here, right? Your market has bid and ask. There are buyers and the sellers at the same price. Why are there buyers? Because they believe that the company will grow by X percentage in future. And why there are sellers? Because people believe that the company will grow lesser than X% in the future. So every person can have a judgment about the future. And that's where forward PE estimation becomes a critical judgmental aspect. Can a normal investor do that? Well, anyone who has focused on few specific industries or stock and who has seen the historical performance of that stock fundamentally can definitely make an attempt to estimate the future. But someone who has come into the market of late recently and just observed the stock price, it's so difficult to make a judgment about the future earning potential of the company just by looking at the stock price.
That's fair. That's a very fair point. And we'll come to earnings and other metrics to watch in just a bit. I do want to ask about the newer companies that are hitting the market, Vivek, because these are companies that are not earning, they're not making profits. So would you say that price to sales is something you can look at? And of course, none of these metrics can be looked at in isolation. They have to be looked at in combination of various other things. But price to sales, according to you?
Yeah, so, different sector, different industries, different companies have different, you can take a different method to value them. It typically starts with bottom line. So PE is like you are relating it with the earning. And when the market becomes extremely bullish, then people start looking at the multiple of sales. because by the time earning multiple becomes so expensive, everything looks so expensive that people start moving up the ladder, which is multiple of revenue. And if multiple of revenue also starts becoming expensive, then people start getting into sum of part method, which is that if I break this company into multiple companies, how much cumulative value which I can see in that company. So, at every stage of the bull market, people do adapt to new methodologies of valuing a company. Coming back to startups, now startups, whoever are getting listed, are not the stories of 2 years, 4 years, 5 years. Typically, these startups are expected to be there in the business for a longer time frame. So measuring them based on current earning or current revenue is also probably not the right metric. So if you see, before a company gets listed, all these startups get listed, they are typically measured on the basis of top of the funnel. That means one line item above the revenue, which is number of users, repeat users, and how many people are renewing the services, etc., etc. So once the company has shown fair bit of traction in terms of user acquisition and user retention, then revenue becomes the second level of metrics. For a listed startup, I think you pointed it correctly that probably multiples of revenue is the one which current market is asking us to value. But eventually, over a longer time frame, when bull market becomes stable, people will start looking at revenue and start giving the multiples of profit as the final multiple of the company.
Speaking of the metrics that one would need to look at when you look at it, it is earnings season already. Vivek, a few companies coming in already. It is important for the individual investor to also understand the company that they're investing in. So, what earnings parameters, according to you, are key to watch?
See, market always has an expectation with respect to earning, right? And the stock price already has that expectation embedded as part of the price movement. Now, whenever earning comes, there's a disappointment or there is outperformance with respect to the expectation. So, first thing first, if anyone is looking at the stock prices based on the earning release of the company, one should know what the market is expecting. And there are multiple media platforms like yours who are giving expectation of the earning. So whenever you are trading in any stock, you should know the earning expectation, and you should see whether that earning has gone beyond expectation or under expected. Having said that, earning of a quarter is just a number which gives a symbolic number that this quarter company has done well. But if you see the trend of last 4 to 5 quarters, that trend will give you a clear indication of what can be expected in coming few quarters. And finally, a long stock price movement, either on the downside or on the upside, is largely dependent on the future estimated earning, which is for a coming 4 to 5 quarters. So look at the trend of earning for last 4 to 5 quarters before you make a judgment about the potential earning in the coming 4 to 5 quarters.
Okay, that more or less answers the question. And you've stipulated, of course, you look at growth, you look at profitability, you look at efficiency, and all of these factors. I've come across a lot of individual investors slash traders, but we're focusing on investors today, that have that one stock that they bet on, Vivek, in their portfolio, and that has gotten consistently drubbed, that is underperformed, and it's bleeding their portfolio. What is the strategy that one should apply with regard to cost averaging on the downside? And at what point do you draw the line and say, okay, this is something that I have to book a loss in?
So it is widely said that, traders, they average up. That means they average when the profit is there, and investors, they average down when the losses are there. Why? Because, when the stock price is going down and you have invested in that company, that means you should be happy about it, that the stock price is now going down and you have a better margin of safety. But that is only possible if you know that company in and out, and you have been tracking the business properly. Every quarterly result you are tracking, you are hearing the management commentary, which is so important because ultimately the company will do good only if the management can walk the talk. So if you have a stock in hand and if the price is going down, please read the management commentary. Try to read as much as possible about the industry where the company is, and see if there is any goalpost shift which has happened. And if there is any shift, then definitely that will impact the company over a longer time frame, and it could jeopardize your wealth creating opportunity in that company. So if there is any shift, then better to exit. But if you feel there isn't much shift in the industry outlook or in the management conduct, then I think you should be happy that stock is available at a lower price and keep on adding that stock as a long-term portfolio.
Ahead of the chat, I had also asked Vivek about what people who are starting up with the investment in the stock market should do in terms of a ratio. And he said that ideally when you're starting out, 70% should go towards mutual funds and 30% towards equity. And eventually you can build up to reversing that ratio. Vivek, apologies for not letting you answer that last question because we're completely out of time. It's been an absolute pleasure speaking with you. And I am sure that a lot of my viewers have benefited from it.
Thank you.